A gas station. That's it. That's where this story starts. Not a bank, not a tech company, not some shadowy hedge fund on Wall Street. A humble pipeline company in Houston, Texas, that somehow grew into one of the largest companies on the planet, and then destroyed itself, took thousands of people's life savings with it, and rewrote the rules of corporate fraud forever. This is the story of Enron. And the scariest part? Nobody saw it coming. Because on the outside, everything looked perfect. Let's go back to the beginning. 1985. A quiet, boring natural gas pipeline company called Internorth merges with another quiet, boring natural gas pipeline company called Houston Natural Gas. The new company needs a name. They call it Enron. Nobody cares. It moves gas through pipes. It's about as exciting as watching paint dry on a Tuesday afternoon. But then they hire a CEO named Kenneth Lay. And Kenneth Lay has a vision. He doesn't want to just move gas through pipes. He wants to sell gas, trade it like stocks. He wants to turn energy into a financial product, something you could buy and sell like baseball cards. And in the early 1990s, he brings in a consultant named Jeffrey Skilling to help him do it. Here's where things get interesting. Skilling was different, obsessive, brilliant, terrifying in a boardroom. He had one idea that he believed in completely. You don't need to actually produce much to make money. You just need to trade fast, look smart, and convince people you're the future. He pushed Enron away from owning physical assets and toward pure trading. Forget pipelines. Forget storage tanks. Forget anything you can touch or hold. Just trade. Just deal. Just move numbers around fast enough that nobody can keep up. And for a while, it worked. By the late 1990s, Enron wasn't really a gas company anymore. It was trading electricity, internet bandwidth, even weather derivatives. Yes, you could literally buy a contract betting on whether it would rain next month in Kansas City. They had an online trading platform called Enron Online that was reportedly doing billions in trades every single day. Every single day. The stock price was climbing. The magazine covers were coming. Fortune named Enron America's most innovative company 6 years in a row. 6 years. The employees believed it. The analysts believed it. The investors believed it. But here's the question nobody was asking. Where was the actual money? Because here's the thing about trading weather derivatives and internet bandwidth. It sounds incredible. It sounds futuristic. But at the end of the day, someone has to actually pay. And Enron wasn't making the kind of profit that matched the hype, not even close. So they did something about it. Something that would eventually bring the whole thing crashing down. They invented the money. Not literally, but almost. Enron had a finance executive named Andrew Fastow, and Fastow was a genius at one very specific thing: hiding losses. He created hundreds of partnerships with names like LJM Cayman and Raptor that existed for one purpose only: to absorb Enron's bad debts and failed investments so they never showed up on Enron's official books. Think of it like this. Imagine you owe your landlord $10,000 you don't have. So you create a second version of yourself, hand the debt to that version, and then when your landlord checks your bank account, it looks clean. Except the second version of you is also you. And the debt is still real. It didn't go anywhere. You just moved it somewhere the landlord couldn't see it. That's what Enron did for years. And the auditors who were supposed to catch this? A firm called Arthur Andersen, one of the most respected accounting firms in the world. They signed off on everything, every quarter, every filing, every number. Later, we'd find out why. Anderson was earning tens of millions of dollars a year from Enron, not just for auditing, but for consulting, too. That's a serious conflict of interest. When the people checking your homework are also getting paid by you to do other work, the incentive to ask hard questions quietly disappears. Meanwhile, the stock kept climbing. It hit $90 a share in August 2000. Employees had their entire retirement savings in Enron stock. They were encouraged to hold it, told to buy more. "This is the company," the executives said. "This is the future." And then, almost quietly, things started to crack. It started with a single question from a Wall Street analyst named Richard Grubman during an earnings call in April 2001. He asked Skilling why Enron was the only major financial company in America that didn't release a full balance sheet with its quarterly earnings. A completely reasonable question. Skilling called him an asshole. On the call, in front of everyone. That should have been the moment. That should have been when people realized something was very wrong. But the stock barely moved. People trusted Enron too much. The reputation was too strong. The story was too good. Then, in August 2001, Skilling resigned. Suddenly, after less than a year as CEO. He said it was for personal reasons. He sold tens of millions in stock before he left. That's when a woman named Sharon Watkins stepped forward. She was a vice president at Enron, and she wrote a letter directly to Kenneth Lay that said, plainly, "I am incredibly nervous that we will implode in a wave of accounting scandals." She laid it all out. The fake partnerships, the hidden losses, the fiction that the whole company was built on. Lay hired lawyers to investigate. The lawyers reported back that everything was probably fine. Those lawyers were also paid by Enron. Shocking. By October 2001, Enron was forced to announce a $618 million loss and wipe over $1 billion from its shareholder equity. The stock started to fall. Then, faster. Investors started asking questions. Journalists started digging. And the whole structure, every fake partnership and hidden debt and fraudulent number, started collapsing like a house of cards in a hurricane. In December 2001, Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in American history. The stock that had been worth $90 a share just 16 months earlier was worth 26 cents. 26 cents. 20,000 employees lost their jobs. Most lost their retirement savings at the same time because it was all in Enron stock, and that stock was now worthless. People who had worked there for 20 years walked out with nothing. Literally nothing. And the executives? Kenneth Lay was convicted of fraud and conspiracy, but he died of a heart attack before he was ever sentenced. And under U.S. law, his conviction was vacated after his death. Jeffrey Skilling was sentenced to 24 years, later reduced significantly through appeals and early release. Andrew Fastow served about 6 years after cooperating with prosecutors. Arthur Anderson was convicted of obstruction of justice for shredding documents related to the investigation. The firm, once one of the 5 most powerful accounting firms in the world, effectively collapsed. Around 85,000 people lost their jobs globally, most of them completely uninvolved in the Enron scandal, because the firm's reputation was so destroyed it couldn't survive. But here's the part that stays with you. Enron didn't fail because of one bad decision or one rogue employee. It failed because of a culture that worshipped the appearance of success over actual success, where the stock price mattered more than the product, where being seen as innovative was more important than being innovative, where the question, "How does this actually make money?" was treated like an insult. Skilling ran something called rank and yank every year. The bottom 15% of performers were fired, no exceptions. It created an environment where people were terrified to admit failure, terrified to raise concerns, terrified to ask questions. Because asking questions got you ranked at the bottom, and being ranked at the bottom got you fired. So nobody asked questions. And the lies got bigger, and the fake partnerships multiplied, and the losses grew and grew until they couldn't be hidden anymore. There's a word for what Enron built. It's not innovation. It's not disruption. It's not visionary business strategy. It's fraud. A roughly $60 billion fraud dressed up in press releases and magazine covers and a stock price that made everyone feel like they were part of something historic. They were, just not in the way they thought. The humble pipeline company from Houston that wanted to become the future of energy became the most studied corporate collapse in history. Business schools teach it every year. The Sarbanes-Oxley Act, which fundamentally changed how every public company in America reports its finances, exists entirely because of what happened here. And somewhere in all of that, 20,000 people lost their jobs. Retirees lost everything. A city lost a piece of its identity. And the word Enron stopped meaning a company and started meaning something else entirely. It became a synonym for the oldest trick in the world, telling people what they want to hear for just long enough to take everything they have.